Good morning from New York. Welcome to our investor spring update for the Worldwide Healthcare Trust. And similar to our fall update, we are going to split the presentation. I'm going to cover the OrbiMed update, a little bit about performance, the portfolio, and the positioning. And Trevor is really talking about the fun part of this business, the big investment themes, what's going to drive the stocks. So I believe most of you are on the call are really familiar with OrbiMed, and maybe Trevor, go to next slide. But just briefly, I want to give a quick rundown on OrbiMed. OrbiMed, we are one of the largest dedicated healthcare investment firms in the world. And we set ourselves apart from our competitors in a number of ways. Number one, it's really the size of the team, with more than 140 people on the team, 30 and PhDs, MDs, 15 ex-biotech, biopharmaceutical CEOs and senior industry executives. So size of the team, very, very important. I think another very important differentiating point is we invest in every single healthcare subsector, not just therapeutics like the drug and the biotech companies, but invest them also in the medtech companies, tools, diagnostics, services companies. And the one common theme across all of our investments is that invest in the most innovative and highest growth companies in the healthcare space. And we find that highest growth and biggest innovation any place in the world. So we are really, truly global investors. We have 12 locations worldwide. Another very important part is we are investing at every single stage of the development of healthcare companies. So we are very, very strong private equity investor, venture capital investors. So we are start investing at the university startup stages. And subsequent actually to our call in the fall, we announced in October 2023 that we had raised an additional $4.3 billion for our private equity funds and venture capital funds. These were free additional funds. So very, very excited about that. And you can find the press release on our OrbiMed website. But look, we are here to talk about the Worldwide Healthcare Trust, and at $2 billion, £2 billion, it is the largest OrbiMed fund. It's really our flagship fund here inside the firm. And another fun fact is actually, of the 12 locations worldwide, we finally actually made a move in the UK. We opened up an office in St. James Square in the summer of last year. That office is headed by Dimitri Sweden and Dina Chaya, two really senior, very experienced healthcare investors. And they're really spearheading our London office, and they're looking for deal flow from Europe. We have always invested in Europe. This is nothing new. We've invested from day one in Europe, but having a dedicated office in London is something new to us. I'm very excited about that new office. So coming really to the meat of this presentation, so first I'm going to cover performance. And then I'm going to start out a little bit on the investment themes, talk a bit about some of the most important secular driver in our sector, M&A. And then Trevor is taking over for that. And then it goes back to portfolio positioning and our playbook, and then the Q&A session. Talking about performance, and first half of our fiscal year was really choppy. We had some great performance early on, and then summer and fall was really difficult again. Where some bigger macro themes like inflation fears and higher interest rates were really putting pressure on the more innovative, high growth companies in our sector. But bottom was really reached October 31st. But then we had a really nice rally here going into year end, and that rally continued onwards in the year. And here, the Worldwide Healthcare Trust, the NAV is now up 10.3% for the year, and we are beating out the MSCI Healthcare by a nice, healthy margins. And if you look at the attribution by subsector, so here you see again, Worldwide Healthcare Trust up 10.3, our benchmark 8.3, big drivers there. Large cap pharma, and our top 1-2 names in the this fiscal year were Eli Lilly and Novo Nordisk, the big winners in the weight loss space. Eli Lilly was 366 basis points, Novo Nordisk 261. So those are two of our very large positions inside the fund, and they have been generating great performance. Number 3 and 4 performers were actually medtech companies. So Intuitive Surgical with 226 basis points and Boston Scientific with 165 basis points. So two big winners there. Then number 5, we're starting with some biotech names. Mirati Therapeutics, that was a takeout name in the fall of this year. Number 6 is a hospital company, Tenet Healthcare. And number 7 and 8 are 2 biotech companies, Iovance and Vaxcyte. And then number 9 is actually a diagnostics and tools company, and number 10 performer is Merck, and that gives you a little bit of flavor of dispersion of the growth. So we had some good picks here across every single subsector. Nice performance here from our biggest core holdings inside the fund. We had a little bit negative attribution from on the private side. Japan, in pharma had been difficult here in the second half of last year, and emerging markets have just started to see some spring blossoms here in recent weeks. But overall, in the fiscal year, we still lost money in China in emerging markets, but made some gains in India. And then coming to our long-term chart, obviously what we like to see is that our NAV is very, very close to our all-time high. We're within 3%, I think, today of our all-time high, which was set when actually biotechnology peaked in February 10th of 2021. So, we're quite optimistic, soon to get to a new all-time high. But the one thing what we are obviously very frustrated about is that our share price has not kept up pace with the NAV. Our discount to the NAV has been stubbornly here at 10 to 12%. This is one area where we have been put a lot of focus there. Our board of directors extremely focused on that. We have been talking a lot of our shareholders as well, how to narrow the discount. Part of it, you probably know, we have had probably one of the industry's largest share buybacks. We're very active there. I think we're very active as well on reaching out to investors, trying to tell our story. I myself was together with our chairman, Doug McCutcheon, on the road last week in London, and Trevor is actually coming to London in May, and then it's back for me as well in July. So we're really focused on that. This is one thing. What we really want to achieve is really narrowing our NAV discount, and really that it catches up with the true underlying portfolio of the performance of the fund. Next slide. We haven't had that in a while, but it's a good reminder as well. This is our performance record since day one of inception, vis-a-vis every single trust out there in the UK. So this is not just healthcare trust. We are the oldest healthcare trust out in the UK, but this is across everyone else. We're quite proud, that we are the second best performing trust out there. So our long-term record, I think, is very much intact. Now coming to the investment themes, and I cover the point number 1 and number 2, and then 3 to 8 is Trevor. 2023 was a remarkably difficult year for healthcare. This is not just biotech, but broadly healthcare in general. This was been the worst relative performance for healthcare stocks in the past 20 years. So truly remarkable. Healthcare did not participate with the Magnificent Seven and the tech companies out there. This year, it started, I think, on a better footing. So here you see, healthcare is actually the number three performing sector, and that performance has been broad-based. It has been the large cap pharma stocks, the weight loss stocks, Lilly and Novo are still again leading the pack. But I think pharma stocks had a bit on them. But emerging biotechnology companies performed as well, encouragingly the first 2 months of the year, med tech companies as well. So I think hopefully, this trend is going to continue throughout into the end of our fiscal year, March 31st, and throughout the calendar year 2024. The next chart, we have shown this quite a few times, but it's a couple of interesting points here. This has been the longest lasting biotechnology bear market in the history of our sector. The start of the biotech bear market actually coincided with our record high for the worldwide, the NAV record high for the worldwide healthcare trust. So this was the longest lasting, the biggest absolute drawdown, and the biggest relative drawdown vis-a-vis the broader markets. But the first real bottom was really in the second quarter of 2022. This is when M&A activity started, in May of 2022. We had a little bit another leg down to that support level in the fall of last year, and the absolute record low was actually set on October 31st. But the good thing is we have seen some spring blossoming in biotechnology as well. So here you see at the tail end, it has been a nice little leg up there. But as you can see, to catch up with the broader market indexes, there is really a lot of upside potential still here in biotech. Biotech versus a broader market is extremely cheap. And healthcare, by the way, vis-a-vis the broader market, is very cheap as well. If you strip out Eli Lilly or Novo Nordisk, which live in their own universe, the healthcare sector is trading at a very healthy 20% discount to the broader market averages. We have been talking about over the last few investor updates about the most important secular theme in the healthcare sector. And I think this trend is going to continue unabated at least until 2025. M&A has been rampant inside our sector. I mentioned already, it started in the second quarter of 2022, but then it continued throughout 2023 into 2024. And if you look at the M&A impact on worldwide healthcare trust, we have been fully participating. You see here on the chart that there have been 48 acquisitions, and 20 of the 48 acquisitions were represented in the worldwide healthcare trust. Now, 4 names were bigger, large core names in the biotechnology sector, so Global Blood, Mirati, Seagen, and Turning Point. But then here is another very important part of the portfolio. And I sometimes, I get a feeling that our investors misunderstand it. We have something in our portfolio. It's actually our largest position portfolio called the M&A basket. And the M&A basket is actually the most active managed part of the portfolio of the worldwide healthcare trust. We adjust actually this basket every few weeks, and we had a range of 15 to 50 stocks, which are the most promising M&A targets out there. So we're constantly adjusted when some of these names get acquired. We take them out of the basket, and our traders readjust the basket basket size. And this has been an extremely successful instrument. This M&A basket created 239 basis points of performance in the current fiscal year. And here you can see it, how it has performed versus the broader biotechnology benchmarks, like the XBI, which is an emerging biotechnology index, and the NBI, that's the Nasdaq Biotechnology Index. And those indices have been powered as well by a lot of the M&A activity as well. But you see, like this part of the portfolio, which is superly active, managed by us, more than double actually the returns of the broader biotechnology sector. So this has been a very, very successful part of the strategy. An incredible focus of the portfolio management team goes into this largest position inside the portfolio. And with that, I hand it over to Trevor, because he's going to update us what the large cap pharma executives are saying about M&A.
Yes, I will. Thank you, Sven. So since the turn of the calendar year, Sven and I have been getting that question about, will M&A continue in 2024? And a word, yes, is the answer. And why is that? Well, the large cap CEOs, as Sven alluded to, told us it would. And on a serious note, we attended the JP Morgan Healthcare Conference here this past January. This is the largest, biggest, most prominent healthcare conference that we have for our industry. And it's extremely well attended. And we focused on what the large cap pharmaceutical execs were telling us. And to a person, they talked up the continued need to do M&A. Unequivocally clear message that despite the robustness of the M&A so far, that it would continue. And sure enough, here we have 7 deals in the first 7 weeks of the year. And while it's been a little bit quiet over the past couple of weeks from M&A perspective, I think this pace is going to put us somewhere in the vicinity of last year's record year for M&A. So what is really driving this M&A? Well, simple one-word answer, it's innovation. Industry pipelines across the space have really grown dramatically since 2016. And you can see here over 70% growth of the pipeline across all therapeutic categories. And this also excludes COVID, by the way. But innovation here is more robust than ever. And we've been talking about this for a while, but we continue to live and thrive in a golden era of innovation and productivity within the biopharma space. And what is the source of this information and this innovation, if you will? Well, it's predominantly and by far the biotechnology industry. Nearly 2/3 of the broad industry pipeline comes from biotechnology companies. And perhaps even more interestingly, over half of all the new product approvals over the past decade have ultimately originally been sourced from biotech companies. So the not invented here mantra is very dead in the biopharma space. And this keeps the M&A engine alive and robust, both now and into the foreseeable future. And looking at a new product scorecard for the industry, if you will, the new product approvals approved by FDA. Well, 2023 was a record year with 67 approvals for the industry. And there was many key approvals in the year that I thought were fairly notable, such as Leqembi, which is the first modifying agent for Alzheimer's disease ever to be approved. Zepbound, which is Eli Lilly's obesity offering. We had the first ever gene therapy approved for Duchenne's muscular dystrophy, and so on and so forth. But I think what's even more interesting is the fact that we've had nearly 400 new product approvals over the past 7 years. This is an incredible amount of productivity in the industry, and we think it continues. Some of the potential new product approvals that we're expecting here early in 2024, there's quite a few. Some that I would highlight would include, for example, Dato-DXd. This is an antibody drug conjugate offering from Daiichi and AstraZeneca. This has been filed in lung cancer. And this new drug has the potential to revolutionize the treatment of cancer and create a chemo-free sparing agent that could radically change the treatment of lung cancer going forward. Of course, donanemab is another Alzheimer's disease antibody. This would only be the second approved Alzheimer's therapy, and we're waiting an advisory committee meeting later this quarter to see if that garners approval. And another interesting asset I would highlight here is sotatercept from Merck. Sotatercept, this is a game-changing treatment for patients with a lung disease called PAH, which is pulmonary arterial hypertension. This is a very difficult disease impacting quality of life. And this therapy, we think, is going to be a game changer for those patients. Well, the disease areas that we're watching this year, there's many, and I'll discuss a few of them here over our next few slides. And of course, I really must start with obesity. This has become the topic in healthcare for about the past year. It's seemingly taken over almost all of healthcare. So what are we watching for in 2024 on the obesity front? Well, Zepbound, as I mentioned, for Lilly, just launched last December. We're watching the prescription trends here early in 2024. And so far, it's looking like the best GLP-1 launch ever. We're also watching the global rollouts. So far, the excitement of these drugs has mostly been in the US, partially due to supply issues, but the companies are slowly, methodically rolling out Wegovy, which is Novo's offering, and Zepbound in European markets. So far, that's been slow due to supply issues, but it's been very interesting to note that it's 100% private pay, and the demand is so far off the charts in the limited distribution that we've seen so far in a handful of European countries. Clearly, the big question this year is on supply. We do know for sure that every GLP-1 molecule and syringe that is produced this year will be sold. The demand is incredible. The companies have not been specific or quantified the supply opportunity so far this year, but the commentary has been very positive, and we're hoping to avoid the stop-starts that we saw throughout 2023 from a supply point of view. Additional indications. These drugs will be approved for indications outside of diabetes and obesity. We've already seen important data in kidney disease. We just saw additional important data in peripheral artery disease. Heart failure looks very promising. Liver disease, also very promising. And a little bit under the radar, we'll have an Alzheimer's disease readout. Yes, Alzheimer's disease and GLP-1s will know some data in 2025. But of course, lifecycle management and competition has also been a big talking point here. What's really interesting is both Lilly and Novo already have their next generation injectables in late phase 3 development. A very difficult hurdle for many trying to get into the space to overcome. And of course, there's a lot of buzz on oral alternatives to these injectable products. And Novo showed us a little preview, some early phase data last week that moved the stock higher. Ultimately, I think the big question that I've been wrestling with over the past year is this a $100 billion market, or can it be $200 billion? Well, since I first proposed that question, consensus has moved a little bit higher. I think consensus is probably around 125. I think 200 billion is certainly still in the cards, however. And of course, perhaps the biggest game changer in obesity was the SELECT trial that read out last year. And as a reminder, this was a first of its kind trial where Novo was testing the cardiovascular benefits of Wegovy in 18,000 obese patients across the globe over 5 years. And this is already on top of standard of care medications. And just as a reminder that Novo showed this data late last year and showed an incredible reduction in MACE, which is a composite endpoint. But basically, it said you have a 20% less chance of having a heart attack, stroke, or dying from a cardiovascular event. This was a complete game changer for these drugs, as now that we have outcomes data, it was a really watershed moment, not only for the efficacy of these drugs, but also reimbursement going forward. Another important sector that we're watching in 2024 is Alzheimer's disease. And I think commercialization here is the real key to 24. Leqembi was approved in the middle of last year. The launch has been slow, but the physician interest in the drug remains very high. There's been a lot of logistical issues in bringing a new-to-drug to market in a space there was no alternatives. And we see that continue to inflect going forward. The approval of Lilly's drug, I think, will be an important moment in the disease space to help build this market with a huge addressable unmet medical need. Also, what will help that is new formulations. Leqembi has a subcutaneous formulation, which could be a real game changer in terms of uptake in the space. And of course, we have new targets, next generation products, and maybe even a couple of new entrants over the next couple of years. And it's really exciting. The key question for me here is Eisai, can they make Leqembi a 1 trillion yen product? They said yes. They actually even raised their peak sales forecast just last week. We will be sticking with the stock for now. Oncology, well, it's really hard to talk about anything in the healthcare space without talking about oncology. Despite obesity and what's going on there, oncology still remains a very important space that can drive value creation in 2024. And I think I ought to draw your attention to some of the things here on the top row, starting with immuno-oncology and the advent of IO combinations, which could raise the bar in terms of the treatment of solid tumors. And here, Merck is really in control of this. We'll have multiple proof of concept readouts and also some pivotal readouts, which I think would be critical for stock re-rating in 2024. I mentioned ADCs, which is antibody drug conjugates. Here, Daiichi and their partner Astra are in the lead pole position. But Merck has also done collaboration with Daiichi as well. Plus, they have their own ADCs. And of course, Pfizer closed on the Seagen deal and inherited a suite of products there. We'll be watching that very closely. Then finally, I just call out bispecifics. Bispecifics, we're on to third-generation products there. AstraZeneca has 3 of them. We'll get proof of concept data later this year. And I think that could really alter the cancer landscape if any of those read out positively. And then finally, vaccines. It's really interesting. The focus in the vaccine world it was previously on COVID for obvious reasons. But there is a lot of excitement elsewhere in the space. And I think this category is often overlooked. But the opportunities here are the most durable opportunities in biopharma. Reimbursement is almost always a given. And now many of the new vaccine offerings come with premium price opportunities as well. And again, I'll just focus here a little bit on the top row with RSV, which is a severe lung infection. This battle is just beginning, but looks like GSK has really taken a lead position here. Pneumococcal vaccines, Pfizer is the incumbent champion, if you will. But Merck, I think, has probably the most near-term, best-in-class offering. But GSK, once again, might have an even better opportunity later in this decade. And then flu. Flu's been a commodity opportunity historically with egg-based derived products. But mRNA opportunities are looking very interesting. And again, GSK, very prominent in that space as well. And that underpins part of our long thesis on that name, which is represented in the portfolio. And I'll just leave you with this. Last year at this time, these are the slides I showed you that the disease items that we were looking at in 2023 and some of the catalysts that we were looking at then. And look how overwhelming last year was for many of this. 11 of the 12 clinical catalysts that we identified for the next big thing were positive. All 5 of the catalysts to watch in large cap pharma last year were positive. And we had at least 9 landmark firsts in biotechnology, which really underscored the innovation in that space. And even medtech, we were 1 for 2, and it was really 2 for 2, as Intuitive just had a slight delay in their debut of their new robotic surgical suite, which we'll see this year. And here's a summary and preview of some of the things that we're looking at in 2024. I tried to keep this as limited as possible, like I did last year, but that became impossible to do. There's so much going on this year in the biopharma space. Here's 12 categories, 30 clinical assets that we expect to get meaningful data on this year. This is a plethora of catalysts, and each has the potential to re-rate any of these stocks higher. And now just quickly moving to a couple of other themes on legislation and politics. The IRA and drug price reform has been a big talking point last year, since it really passed in August of 2022. And we have analyzed this at length, and we continue to do so. And our views are unchanged. That the cap on drug pricing, which came into effect last year, has been really neutral. The addition of out-of-pocket caps, which will come in 2025, should be positive for prescription volumes, especially for chronic conditions. And finally, the one issue probably with the most angst is drug price negotiations, which is still over 2 years away from coming into effect. So what's happening in 2024? Well, the first round of negotiations are currently underway. And at least one CEO, that of AstraZeneca, has characterized those negotiations so far as encouraging. But most companies have been tight-lipped about it. But I think that is a positive talking point. Also interesting to note that there has been bipartisan legislation tabled supportive of extending the small molecule pricing exclusivity to 13 years from the proposed 9, which would match biologic exclusivity. I think another potential positive to come here. And just as a reminder, there's also significant active lawsuits that are ongoing, as court action has begun in earnest here, with 9 active lawsuits across 9 companies. And I would expect those lawsuits to shift to argument claims around financial damages once final negotiated prices are announced after September 1 of this year. So I think there's more to come on the IRA, and some of the developments could actually be a net positive moving forward. And finally, just from me, a word on the US presidential election. You know, election years always bring about a lot of noise and headlines as we progress to election day. But more so than any other election year in my history, I think this campaign is really just going to be rhetoric and noise and not amount to any sort of material changes come November. And why is that? Well, I simply don't expect any substantive legislation to be passed that would adversely affect drug prices in the near term. If Biden holds and we see a Democratic sweep, this is really just the status quo. And they've already passed the ACA, they've already passed the IRA. I'm not sure there's really anything to do there. And a Republican sweep, well, this party has been historically pharma-friendly, and they may even try to revoke some of the most egregious parts of the IRA, such as drug price negotiations. So there could be something positive that comes out of a born-again Trump regime. But finally, divided government, which federal government remains in gridlock, nothing gets passed there. I think that's status quo, and that's probably the most likely outcome, is really status quo. And I think that is positive for our sector. So with that, I'll pass it back to Sven to discuss a little bit of portfolio and position.
Well, we are already running a little bit behind time, and we want to leave some time at the end for the Q&A. So I'm going to move a little bit faster here. But if you see at the portfolio positioning, I think some of the key strategic moves there are obviously when you look at big pharma versus emerging biotech, we are very, very much so heavily overweight the innovative emerging biotechnology names vis-a-vis the MSCI benchmark. And big cap pharma has always been our funding, a funding source for supporting our investments in the more innovative companies. I think just recent moves here have been, we added a little bit to life science tools. MedTech has been pretty flat over the past year. And healthcare service, important move. We sold quite a few of our big services, HMO players. So Humana is out of the portfolio. We significantly reduced our United Healthcare position there. So major change there. And big cap pharma, we aligned quite a bit some of the names. So Merck has been a new position. We increased in Glaxo Wellcome. We actually shifted even on amongst our bigger weight loss names from Novo Nordisk, shifted some of our gains into Eli Lilly. Emerging markets has been a tough sector, has been here around 5.45% for a while. We haven't added yet significantly there, but we still have great hopes, I think, for that subsector. Now, privates, we finally actually expect some IPO activity in the remainder of the year, and we're quite hopeful that one of our largest private equity holdings maybe has a chance to go public later on this year. Now, when I was out on the road, last week, I think a lot of our investors, they ask us, "Hey, you are so big in biotechnology, and our big biotechnology exposure has been the core part why we had some tough performance here in 21 and 22." And they're all asking us, "Is this something new? Did we change our strategy? Have we dramatically increased our biotechnology exposure?" And I think this here is actually shows you how have we historically been exposed to it. And, this the earliest data I was able to get, in 2006, we started in 1995, but the portfolio management software changed over in 2006. So we have data back to then, but I think it would show the same picture actually in 1995 as well. This found the secret recipe to the long-term success has always been to be majorly overweight in the key innovation engine of this of the healthcare sector, which is biotechnology. This has always been the key part in the C here. In 2006, it was close to 30%. 2013, close to 30%. 2020, when biotech was running, it moved up a little bit on performance. 22, a little bit touch below, because it was terrible performance, and we actually added to our biotech exposure back in 2023. But this has been really the consistent trend inside the fund since its very, very first days of inception. And this is where you can generate alpha in the long term. The market is not as efficient in the small cap biotech space. This is where stock picking really pays off. And this is where we're really convinced that will add alpha over our benchmarks in the long term. A little bit on our portfolio exposure. You see here the biotechnology exposure there, close to 30%. Right in the middle of the page, you see the M&A basket, 9%. It's now our largest holding together with Eli Lilly. I talked about this before. Very, very actively managed, I think, from our biotech team on an ongoing basis. This is not a passive instrument. This is the most active part of the portfolio management process. Big cap pharma, two biggest holdings here, Novo Nordisk and Eli Lilly. Obviously, they go from strength to strength. AstraZeneca, very, very important large cap pharma holding there as well. And then two Japanese names, Daiichi and Eisai. In the medtech space, really our core holdings there, Boston Scientific and Intuitive Surgical, and there have been terrific stocks here recently. And then healthcare services, important change there with a number of the names. It's a really concentrated portfolio. Top 30 names represent 88% of the NAV, and 81% of the portfolio is in profitable companies. So even a lot of the biotechnology names are profitable biotechnology names. Leverage, not much change there. Our borrowing cost obviously has increased a little bit higher. But overall, 110% leverage, which is slightly different from our gearing number. But I think the economic exposure, the leverage is like around 110%. And that's a level what we probably will run throughout the course of this year. And this gets me to our playbook and then to the Q&A. So playbook, key part is stay the course on investing in innovation, high growth companies, stay the course, being big exposed in the biotechnology sector. We think this new product cycle of both in large cap pharma and from biotechnology will create a lot of value creation. I talked about the most important secular theme about this in the sector, M&A. We're really optimistic that biotechnology has turned the corner. And there is the possibility that actually the US election could provide a potentially positive catalyst. So we are overall, given the huge discount of the healthcare sector to the broader market and the fundamental outlook, we remain quite bullish here on our sector in 2024. And with that, we will have 15 minutes to answer some questions. Already, the first few questions have come in. So if you have more questions, please write them down, and me and Trevor will answer them as they come in. So first question, very, very good question, is why do you think the discount has widened despite the NAV moving higher? That's a great question. We OrbiMed and the board of directors, we are asking ourselves this almost on a daily basis. What can we do to avoid the NAV discount? And I think one thing what we have come to the realization that probably 1/3 of it on the NAV discount is manageable by us and the board, by the share buyback policy, being out there marketing, our performance obviously as well. But I think 2/3 of really the NAV discount is driven by bigger industry-wide trends. And, as you probably know, I think one of the biggest factors in the investment trust land is that discounts have significantly widened. And actually, our discount is high, but it's still below the average for the sector, which is around 15%. And that outgoing tide is really difficult to fight. And even if we would increase our share buybacks, I don't think it would make a major change. So we are there. We are actively buying back our shares, but we are trying every single tool in the toolbox to actively bring the NAV discount there. And our goal is still the same old. We want to get to at least a 6% discount, but obviously, preferred choice would be getting closer to parity. And we're not sitting still here. We're working really hard on this. So that's a very important question. I think another question, and I think the second question, I think we can both maybe answer, Trevor. So this is one of our investors asked, there seems to be not too many contested M&As. Is there any reason for it? I think it's a correct observation that you have seen not too many public fights about M&A. So there are not public bidding wars for those takeover targets. But I think the process a little bit has changed there. So typically, the bidding wars actually start behind the scenes before the takeout is announced. So when the bankers actually get a bid from let's say, a large cap pharma company for a biotech company, they will then go out with the permission of the board of directors to all the most logical acquirers. And all of them have a chance to take a look at the company, know it's in play, and if they're willing to bid. So typically what you see is then when you see the merger documents, you see bidding wars behind the scenes where several companies have bid. And then finally, when it is publicly announced, this is then the final outcome where everyone, all the parties who were interested were bidding on it, and all board of directors have already signed off. And this is why you don't see the old traditional bidding wars for assets. And I don't know if Trevor, if you have anything to add there.
I would just add, I think you answered that appropriately. The only thing I would add is that for many of these M&A deals, especially for emerging biotech companies with no commercial ready platform, you know, the most likely or the inevitable exit strategy is a takeout. So I think that puts, you know, contested deals sort of on the de minimis grounds. It doesn't happen that often. Bigger companies, larger takeouts that are already commercial and profitable, that's a different story. But otherwise, in the emerging biotech space, takeout is the fate of almost all those companies, especially the ones with good assets.
Okay. The next question, I maybe take that one is, can you talk a bit about the Trust China exposure and how we view the macro geopolitical headwinds impacting the holdings? It's another good valid question because obviously, you know, behind the malaise in China has been the geopolitical headwinds. You know, both the Biden administration and Chinese government, you know, they have been in a trade war. They have been on, trading shots across the bow. Most recently, you saw Biden administration talking about some of the Chinese CROs that they shouldn't be doing business there. And these macro headwinds have been the driver why actually, just like biotech, China biopharmaceuticals has actually sold off 80% from the high. And similar to biotech, you know, there has been in China is this mismatch between the true underlying fundamentals for the sector, which is very, very good. I think Chinese biopharmaceutical innovation has been at the record high, and we've seen a lot of Western companies going to China to in-license actually Chinese innovation. But there is this disconnect here in the market between fundamentals and macro fears. I think ultimately, I think the true fundamentals will win out. We are still longer term optimistic, I think, about biopharmaceutical companies in China. But I think unlike biotech, the turning point is there could be still some gyration, especially in the election year here in China. And you see, we have a very, very small relative exposure, I think, to China. It has been lower than it has been in the past, and we haven't been quite yet adding to it. Even so, we are tempted. But there are sometimes for putting fresh money to work is maybe some of other areas don't have the headwinds that China currently has. So it's a fair question. We're still sticking to our guns there. We're not exiting China. We love the innovation there, but we are not ignorant to the headwinds faced by the sector. Next question about weight loss drugs. So Trevor, you take that one.
Yeah, this is an interesting question because it's less about weight loss drugs and rather more about because the question asks is are you any stocks or sectors which you're avoiding because these treatments will become a threat in coming years, for example, to medical devices or to other drug companies. In fact, here at OrbiMed and in the trust, we've actually taken the exact opposite approach because some of those companies with material dislocations we felt were much too pronounced, too egregious to that over reflected the threat to them. And actually, we built one of our swap baskets to take advantage of this, and has also been a very successful trade. Sven, I don't know if you want to add any color to our rally basket that we called it.
Yeah, I think this is a theme which has been probably overplayed a little bit by the market, and I think it's going to continue to narrow, and it has narrowed. And so, like every exuberance, both on the positive and negative, they tend to self-correct, and I think this bearishness from weight loss drugs, I think impacting other stocks in the healthcare space will self-correct, and is already in the process. Now, next question there. A little bit difficult. So, this is about correlation of NAV returns relative to the MSCI healthcare to the biotech index has a little bit fallen since mid 22, and the relationship of WWH and biotech vis-a-vis the benchmarks. Look, there are gyrations in within here worldwide healthcare trust and our and benchmarks. Correctly. I think the biggest driver for our underperformance in 21 and 22 was our exposure to more innovative and growth companies. And that's not just biotech. I always talk about biotech, but I think innovation and growth has been on sales across all subsectors. So it has been, for example, in medtech. It has been in China. It has been even in services. So anything in the small and mid-cap space has really underperformed. The large cap names have outperformed. And we in the Worldwide Healthcare Trust, our overweights are not just simply on biotech, it's as well on innovation growth in all other subsectors. This is typically where we are vis-a-vis our benchmarks, much, much more exposed. And I think in general, if you look at the history of the fund for the past close to 30 years, there are all periods of underperformance. They're always correlated when smaller caps, mid-cap stocks underperforming large cap stocks. It was same thing, in 99, 2000, 2007, 2008, 2015, 2018, 21, 22. These are periods where we underperform. But, as I mentioned before, we think, being in the smaller caps, mid-cap companies with higher growth and higher innovation in the healthcare space is really the key recipe to our long-term success. This has been the key ingredient why we have outperformed on the long term, and there will be distinct periods of underperformance with our strategies. We are not benchmarkers. We are not closet benchmarkers where we're just running a fully benchmark every index. We are stock pickers. We are fundamental bottom-up investors, and we will try and pick the fastest growth, highest innovation companies. And we will have our periods of underperformance, and then they will be followed by periods of very, very strong outperformance. And let's see. We have two more questions. So Trevor, you take the next one.
Sure. The next question is, are treatments for addiction coming to market? Does GLP-1 do this? In a word, it looks like the answer is yes. So where are we in that paradigm? Well, first of all, we've seen some early data in some of the so-called basket trials where we have seen positive effects of GLP-1s and things like binge eating, alcoholism, substance abuse, even tobacco usage. And so we'll have proof of concept data coming for some of these disorders. We've also heard numerous anecdotes about real-world patient feedback with either diabetes patients or obese patients already on these medicines, talking about their addiction to things being curbed, especially on alcohol while on these drugs. So I'm sure, well, I'm more than sure, we do know that the companies are pursuing this. The timeline is still probably a few years out, but yes, I think GLP-1, in terms of the plentiful indications that are coming, will include that as well.
Okay, and the final question, there was a follow-up question. What is the impact of the Biosecure Act? And I think this is a question related to the recent moves by U.S. Congress about, curbing the utilization of some of the Chinese biotechnology companies. Some of them are genomics companies. Some of them are as well, like there were companies like WuXi AppTec, WuXi Biologics specifically mentioned in the Biosecure Act. As you maybe know, the U.S. Biotechnology Organization, really, which stands for the whole biotech industry, came out very, very strongly against the Biosecure Act because, the biopharmaceutical industry is very heavily reliant on some of the biotechnology manufacturing capacity, CRO, clinical trial capacity, which, WuXi AppTec and WuXi Biologics provide. And it's very, very difficult to disentangle for it. There are first-class providers, actually, of these services. And many companies are really relying, actually, on product supplies from that. So let's see how it plans out. I think ultimately the Biosecure Act probably maybe will come in one form, come to pass. I think it will, in the end, be as many political things be watered down, and the impact in the long run will be negligible. But I think the stock market impact is real. I think it's a real headline risk, and I think that that is there. And during election year, Joe Biden will possibly talk about it. Donald Trump loves to talk about China and clamping down on China companies. So the headline risk is definitely there. I think the ultimate outcome is going to be more watered down. I think with okay.
I think we're there. I think we're there, Sven and Trevor. Thank you very much for your time today. If I can just jump in because I noticed that we're on the hour, and I think it's a fitting time to pull up stumps at this time. So thank you to you both, and thank you to you, ladies and gentlemen, for your time listening to this. I'm excited about this. I think the healthcare sector, from what I can see here, has seen the longest drawdown, the largest absolute and relative drawdown that anyone can remember in sort of corporate memory. And the market's become wholly disconnected from the really interesting science that you're talking about in recent years. And not only that, the healthcare sector has been left behind by the technology sector generally. And Sven, you mentioned you were on the road last week, and you were with me, and you did mention that actually biotech has essentially gone nowhere since 2015. And how many iPhones have been launched since 2015? I can tell you because I've been looking while you were talking. 14 of them since that time. So all of the science that's being worked on in that time has essentially been, ignored by the market. So large pharma are there. They're hunting for pipeline to drive strong revenue growth, and that's been happening. It's going to carry on happening till at least the end of 2025, and that's coming through Worldwide Healthcare's access to its M&A basket for its shareholders. And that is a theme that's been consistent throughout the years with a circa 30% biotech allocation to really drive alpha and returns. And I think the stock market is at the very early stages of actually caring about this. We've got a gift wrapped opportunity with the shares trading at a 12 or 13 discount. And given the amount of share buybacks that the board have conducted, and we note the question on that particular subject, this is an opportunity. Just don't miss it. So thank you for your time today. The ticker is WWH on the London Stock Exchange. Shares are available via the house broker Winterfloods or your chosen retail platform. Any further questions, please do let myself or one of the Frostro Investor Relations colleagues that I have know. Thanks very much, all. Bye-bye.
Thank you, everybody.